The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, this is Jim Lorenzen, and I want to welcome all everyone to this session on how to plan for your income tax-free retirement. A couple things you need to know about this session. Number one, it's not a little 2-minute video. This is going to last a little over an hour probably, and that's the reason I posted this as something you could do on demand and do it on your own time schedule. Secondly, all the ideas and concepts you're going to see in here are not really original to me. They've been around for quite a while. While I do have a long track record in the business world, both as a company owner as well as an advisor, I'm not a CPA or an attorney. But during my years as a business owner, as well as a consultant to CEOs of some of America's best-known companies, and a lot of others as well, I was able to get a first-hand look at what some of the most successful people were doing that was different from the rest, both inside and outside of their businesses. And I learned a lot from professionals as well, both inside and outside this industry. Well, with all that, plus some academic study, I guess you could say that everything I know I have learned from other people, but that's probably true of all of us. You're also going to hear some opinion, and I think you'll probably enjoy it. And so we'll get on to it. Oh, by the way, I am not, as I said, I'm not a CPA, I'm not an attorney, but I am a certified financial planner, and I'm a registered investment advisor, and I also am licensed for insurance as an independent agent in California, so that allows me to go shopping for my clients and choose from all the different financial service providers that are out there. And that's why the name of the company is the Independent Financial Group. Now, that said, you should understand that this session today should be regarded as information and not advice. Advice is something you should accept only from someone you actually know and knows your situation and is in a position to provide you with custom-tailored informed input. There is no blanket pat answer for everybody. If you should decide you'd like to become a client here at IFG, obviously I'd be happy to have you as a client and help you in any way I can. If you have any questions during this session, write them down. You can email them to me or schedule an introductory phone call with me or whatever you want. I'll give you information on that later on at the end of this session. And so with that said, let's get started. What is the largest expenditure you're going to make in the rest of your life? Raising children, automobiles, recreation, home purchases? A lot of people, quite honestly, think it's raising children. But even if they go to private schools and universities and all of that, or expensive colleges, that's really not your most expensive outlay. Believe it or not, it's this. And the reason is because it begins the first day you start working, and it continues on for the rest of your life, even all through 2 to 3 decades of retirement. Taxes are here to stay, as Ben Franklin once said. That's one of the things that's forever. And there are reasons taxes are a big issue going forward. Let's take a look at the federal budget. If you'll notice over here, this is the 2015 budget. And you look on the left side, and you can see Social Security and Medicare are 50%, approximately 50% of the budget. And if you look in the upper right, you can see that these are the annual deficits that have been run every single year. And while they've been trending down, and in the future they are expected to go back up again out in the out years, but while they've been trending down, they're still added on top of prior annual deficits to create our debt. And the debt has been climbing in recent years and is projected to go up in the foreseeable future. Right now, the debt as of February 2015, the debt was $18 trillion. You can go to the debt clock down here. You can see that. You can go to the debt clock and find out what it is right now. This is the official debt. It was $9 trillion, half this much, just 7 years ago. So how did we double our debt? Double all debt accumulated ever since the beginning of this country in just the last 7 years. Well, that's another story, but it's only half the story. You see, there's a shell game going on. You can see that the official debt is 18 trillion, but the real debt is more like $87 trillion. You see, in May 19th, 2008, there was a USA Today article that explained that accounting standards for the federal government are a little bit different than they are for the rest of us. You see, when we acquire a debt, we have to show the total debt on our balance sheet to be paid, and whatever the outstanding debt is, that's on our balance sheet. Federal government doesn't work like that. You see, the federal government only has to show the outlays for the current year. Bet you didn't know that. They only have to show the outlays for the current year. That's 18 trillion. But the truth is, the real debt, the total obligations, are closer to $87 trillion. In fact, this is 87 trillion in 2012. So now that we know that, that's one shell game. And by the way, you're familiar with the Social Security debate because politicians talk about it every 2 years when they're running for re-election. Here's a statement from the Social Security. You've seen this statement. You probably have gotten one, or somebody you know has. This is the 2009 statement that said in 2017, unless there are changes, they're going to run out of money in 2041. Well, guess what? The government-appointed Board of Trustees now says that the fund is going to run out of money by 2033. So it's happening faster than they anticipated. Here's a quote from the former U.S. Comptroller General. The United States has made trillions of dollars worth of promises it can't afford to keep. The only way to deliver on the promises is to raise taxes, and as you'll see, as you've seen in those charts, and you'll see it later, it's just simple math. The question is, if tax rates go up, how much of your money will you get to keep? Because the government passes the laws and you have to comply. The problem is, ever since the meltdown, this is by the way, the gray line here, the gray zigzag line here, that's the unemployment rate. And you can see in 2008-9, when we had the big credit meltdown, unemployment jumped up to about 10% in 2009. Now, unemployment rate has been coming down dramatically ever since that time. So if that's true, why aren't we in the middle of a great robust recovery? Well, that's because there's a shell game going on underneath. Take a look at wage growth. Wage growth has been trending down for decades, but as you can see, when unemployment went sky high during the meltdown, wage growth plummeted. It's started up again and started to blip back down. What's happening is, yes, people are going back to work, but they're going back to work at lower paying jobs. That's just part of the issue. The other issue is the labor participation rate. A lot of people aren't going back even to low paying jobs. They're just dropping out of the workforce entirely. But you see, when they drop out of the workforce and they quit looking, their numbers are not even used in the calculations to determine the unemployment rate. That being the case, you do the math and you start re-engineering it and you realize unemployment is really closer to 12. That's pretty high. And then, of course, there's interest rates. When the meltdown occurred in about 2008 and 9, you can see that interest rates went down to the floor trying to stimulate the economy, hoping that people would borrow. And they've been on the floor ever since. Why? If interest rates are the price of money, you'd think there'd be demand for capital, would force prices back up. People haven't been borrowing, though. You see, with interest rates down near zero, with wage growth plummeting, with the unemployment, with the labor participation rate going down, people are in lower paying jobs, or they're not, or they've dropped out. They're not anxious to take on debt. And the banks, of course, if they're going to be lending out at almost zero, how much incentive do they have to lend out large buckets of money and take on that risk? They don't have much. That's one of the problems. Now we look at the tax rates. A lot of people don't realize, this chart goes back to 1910, by the way. A lot of people don't realize that from the 40s, 50s, and 60s, our top marginal rates were over 90% at that time. Of course, there was a boatload of deductions. But as the years have gone on, these tax rates have gone down and down and down and down. Historically low rates, going all the way back to the 30s right now. The problem is, as these rates have come down, the government has taken away those deductions, a lot of them. So when the rates, and they probably will, when they start trending up again, and everybody seems to believe, all the experts seem to believe that's what's going to happen. I do too. When they start trending up again, do we really believe the deductions will be reinstated? I'm not so sure of that. It doesn't take a genius to figure this one out. The money is going to have to come from somewhere. And quite honestly, you are in the crosshairs. Ed Slott, who is a widely recognized retirement expert, both among the public because they see him on television all the time, but he's a CPA and he's highly regarded in the financial industry as well, among legal profession, among the accounting profession, and in the financial advisory profession. And he's been warning about this for an awful long time. He's been saying the government is going to need huge cash infusions to meet those commitments I just showed you on those prior charts. And there's not going to be much choice. They can't raise taxes on the people who aren't paying taxes because that's most of them, a lot of them, I should say, right now. They're going to have to raise them on the people who've been working hard, sacrificing, saving, and playing by the rules. Now, I have a question for you. If you were going to go into business with a business partner and start your own little business somewhere, your own small business, and this new partner said he wanted sole discretion as to determine how much of the profits he got to take out of the cash register, and he wanted to have the only vote, and you would have no veto. He gets to decide what he takes out of the register. You get to keep whatever he decides to leave behind. Would you take on a partner like that? Well, you have. You have a business partner right now. His name is Uncle Sam. He has the only vote on his share of your future. And when he needs money, he will take it. And he's likely going to need more over the next 30 years. If he needs something that he wants to fund, he takes it from you, period. End of conversation. Avoiding taxes on the seed money, the money you use to build your nest egg, has just started, built up money for him to harvest the nest egg later. You pay taxes on the seed, he gets a huge harvest, and that's exactly what he had in mind. Here's the way it's been working. You get an income. The money, first money, you've probably been putting into your 401k, your IRA, and things like that. And of course, there are government restrictions. By the way, a couple of things I've learned about the way the government works with investments and money is if they restrict something, it's probably something that's pretty good. And if they require something, it's probably something that's pretty bad. Well, when they restrict what you can do, it's probably something that's pretty good for you. At any rate, they restrict how much you can put in, and that's because the money that goes out from there, you have to pay taxes to the government. They're willing to allow you so much to defer right now, but they want as much as they can get. And that's the way that kind of works. The remaining money after you pay your income tax you have for your stocks, your bonds, your mutual funds, and things like that. That's your taxable bucket. The only problem with that bucket, of course, as we all know, it drains taxes. You pay capital gains tax, income tax on dividends, and things like that. That's your taxable bucket. And the money beyond that isn't in the taxable bucket goes into what we'll call the tax advantage bucket. This is your municipal bonds, your Roth IRAs, and things like that. Money that comes out of here, of course, comes out tax-free, and that's kind of good. The key to strategizing a tax-free retirement is to utilize all three of these buckets in an effective way. Now let's see how the American Taxpayer Relief Act has affected your retirement picture. I love that name, by the way, American Taxpayer Relief Act. They are going to relieve you of something. Guess what? Okay, let's take a look. Well, first of all, under the Tax Relief Act, it passed in 2013, the top tax rate went from 35 to 39.6. That's an increase of 4.6% right there. In addition, there's a 0.9 Medicare tax on high earners of 250,000, joint filers, 200 single. And married couples in urban areas who are both professionals or executives don't have much trouble getting to that 250. And business owners who've been doing well, they don't have too much trouble. People who are working hard and successful kind of get hit. So after paying all this money going in there and you're paying the top tax rate at 39, you got the Medicare tax. By the way, capital gains tax went up from 15 to 20%. And of course, there's the unearned income Medicare contributions tax. That's a result of the Affordable Care Act. That kicks in another 3.8%. And of course, then there's PEP and PEACE. PEP and PEACE. I'm not going to really bore you on all this, but basically they're phase outs of your personal exemptions and your Schedule A exemptions. If you're a high earner, you want to have a talk with your tax advisor about this. So high earner with a spouse and 4 children could lose $23,400 per year in tax exemptions and up to 80% of their write-offs for the mortgage on their property tax, their home, their car, charitable contributions. And if that weren't enough, a person's advisor does a great job. They've built up their retirement assets in the portfolio, stocks, bonds, mutual funds, REITs, SPDRs, ETFs, and all of that. And those assets are outperforming. The tax exposure is increased even further. Well, you're probably saying, well, so what? Well, you're about to see so what. So we see the money flow, and it goes like this. The problem is, as you retire, the day actually you turn 59 and a half, the truth is the money in that tax-deferred bucket really becomes a taxable bucket. Now, inside it's deferred, but any money that comes out, you pay income tax on. And it's going to go, Uncle Sam is going to get his share. Here's the way the timeline looks. Before age 59 and a half, any money you take out of your tax-deferred accounts, 401ks, IRAs, etc., is subject to ordinary income tax plus a 10% penalty. After age 59 and a half, that tax-deferred bucket becomes taxable. Anything comes out of it, you pay. Anything that's inside is still deferred. But you take money out, that's really a taxable bucket. By the way, at age 62, if you have too much modified adjusted gross income, 85% of your Social Security benefits now get taxed. If you have too much modified adjusted gross income at 65, your Medicare Part B costs go up by triple. Well, that's talk to your tax advisor about this. I'm not going to get into the weeds because there are limits on this, and it depends on what your tax brackets are and whether you're filing jointly and yada, yada, yada. But the bottom line is AMT can kick in and a lot of bad things happen. Like I said, you always want to talk to your advisors about everything first. Age 70 and a half, of course, you're probably aware, that's when required minimum distributions kick in and Uncle Sam starts wanting to take his money. So here we go. You have a tax deferred, you have a tax-free bucket. Now, you don't pay any taxes at the bottom here on your tax deferred, and that way everything grows tax deferred, but it's all taxable on withdrawal. On the tax-free side, you only pay tax down here, and then everything that comes out becomes tax-free. So the only question you really need to answer is, do you want to pay tax on the seed, or do you want to pay tax on the harvest? Uncle Sam has engineered a retirement scheme for the American people that allows him to get money on the harvest. And that's why Uncle Sam had this in mind, and why you maybe might want to be thinking about your partnership. But will you really be in a lower tax bracket at retirement? Some people say, yeah, I'm going to be in a lower tax bracket. Well, maybe, maybe not. A lot of people don't have commuting costs and things like that anymore, but they also travel, they go out for dinner, they have more free time. The first 10 years generally are the years that people spend the most in their retirement. But even if your expenses don't go up, tax rates, as we've already talked about and have documented with math, are very likely to be headed up. And at the same time, you're very likely to lose some deductions you're now currently enjoying. For example, mortgage interest, dependent children, retirement plan contributions, and probably charitable gifts because you're no longer working. All of these are likely gone in retirement. So during your working years, you were able to itemize and have a lot of deductions. But with a lot of these gone, and you're in retirement, most married couples are all of a sudden back to their personal exemption and their standard deduction. Now, a married couple, for example, has a standard deduction of $12,600 as of right now, and their personal exemption is $4,000 each. That means a married couple right now can receive $20,600 in standard deductions and personal exemptions. Any provisional income above that amount, any income above that is taxable. Now, here's the good news. That the standard deductions, personal exemptions historically have been adjusted for inflation on an ongoing basis. So if you're retiring in 15 years and you figure a 3.5% inflation rate, it's very possible that your standard deduction and personal exemptions will probably come to something like maybe $34,000. At least that's a number you can probably use for planning purposes at that time. But that's something you'll adjust as time goes on as you're going through your process. But as you're about to see, the asset arrangement for the buckets is critically important. And it's something, in my experience, almost everyone fails to do. You see, everybody gets asset allocations based on asset classes. So much in stocks, so much in bonds, so much in cash, so much in real estate, so much in commodities, yada, yada, yada. But very few people have a tax bucket allocation overlay. And that's very critical. Now, asset arrangement is the key. And I'm going to tell you something. This is not something you can do at the last minute. You can't do this overnight. RMDs begin at age 70 and a half. That means you should probably start well before age 60 and a half, getting your assets arranged properly. And the sooner the better. I would say the prime ages are anybody from age 40, 45 on, 40s and 50s. These are the ones that need to begin arranging as quickly as possible. If you're nearing age 60, you haven't got any time to lose at all. But it takes time to put this strategy in place. It is not something you can do overnight. That's why wealthy people have been doing this. Now, you're going to see later on, you're going to see exactly what I'm talking about. I'm going to explain it all to you. Provisional income determines what percentage of Social Security gets taxed. Now, by the way, that is step number one. If you're going to have an income tax-free retirement, the first thing you have to do is make sure you don't have any tax on your Social Security, because if you don't do that, you don't have a tax-free retirement. So provisional income determines how much Social Security gets taxed. How do you calculate provisional income? It is 1/2 of Social Security, all tax-deferred distributions, that's out of your IRAs, 401ks, 1099s or interest from any taxable accounts, employment income, rental income, and interest from municipal bonds. Ooh, did you see that? Municipal bonds are income tax free. Yes, they are. But the interest from those bonds is used to calculate your provisional income, which determines how much Social Security gets taxed. So how does that work in the real world? Well, first of all, let's look at the brackets. I'm going to show you how it works. Here are the brackets. These came about, by the way, in a compromise between Ronald Reagan and House Speaker Tip O'Neill back in the early 80s. They were trying to save Social Security. And basically, it looks like this. Anybody, a couple is making less than $32,000 or a single less than $25,000, they don't have any Social Security tax to worry about. If they're a couple making $44,000 or more, or a single making $34,000 or more, then 85% of Social Security gets taxed. Those in the middle pay 50. Now there's a stealth tax hidden in here. The stealth tax is this. These brackets are not adjusted for inflation. So as time goes on, single people or married couples getting from 40 to 46 is pretty easy. Getting from 25 even to 34 is pretty easy for a single person. This doesn't take much to do, and this determines how much of your Social Security is going to be subject to tax, and it doesn't take much to do it. Let's look at a real life example. I made it up. I mean, it's a hypothetical, but you know, it looks like real life. Here are the Flintstones, Fred and Wilma. I just dated myself, didn't I? Here's Fred and Wilma. They have $30,000 in combined Social Security income, and they have 40,000 distributions coming out of their IRAs. So here's how now I left off rental income and municipal bond and all that other stuff. I'm just going to work with these two. 1/2 of Social Security benefits, that's 15,000. Their annual IRA distribution is 40. Total provisional income, 55. See that? I told you it didn't take much to get to this. 85% of their Social Security is subject to income tax. And that's the way it would be now. It's going to get worse later because there's no cost of living adjustment on these brackets. So 85% is subject to tax. We told you that there's $30,000 coming out of Social Security. 85% of it's taxable. That's the taxable amount. If their tax rate is a combined 30%, same federal, their tax expense is $76.50 just to pay taxes on their Social Security. But it's worse than that. Fred and Wilma are going to have to take out $10,928 more just to pay taxes on the Social Security, because the money they take out is taxable. So it's going to cost them $10,928 to pay a $76.50 tax bill because their provisional income went over the brackets. How about that? Let's take a look at a tax time bomb example. Here's a Fred and Wilma that are 50, age 50 today. They're going to be retiring in 15 years. This is the time they're going to start thinking, we got to get our ducks lined up. Right now, they got $500,000 in an IRA, and either they're self-employed, let's say their employer is not contributing to a 401k. They've got $24,000 annually that they're contributing into the 401k, and the reason they can contribute $24,000 is because he's over age 50 and they're just doing catch-up. So he's got $500 in IRA, he's contributing $24,000 annually to his 401k, and he's got some emergency money in taxable accounts on the side. Now the problem is, and this may not look like a problem, but you're going to see that it definitely is one. In 15 years from now, when he's 65 years old, at this current contribution level and an 8% annual return rate, at the age of retirement, he'll have over $2 million in his 401k. That sounds pretty good. And even if he lets that 401k sit with no additional contributions, and he's only earning 5% after he retires, and he takes no distributions until age 71, he's going to have over $3 million in that 401k. But you know what that means? If you look at the tables, it forces his required minimum distributions at age 70 and a half up to $115,000 a year. His Social Security is going to be 85% taxable, plus he'll be paying tax on this, and we don't know what the tax brackets are going to be at that time. But we do know up is a lot easier to believe than down. We've already gone through all of those slides. You can always back up and look at them again. Capital gains and dividends, of course, are subject. They've been growing all this time, and he's going to be paying taxes on those as well. In fact, when you look at this, he's probably got about $1 million in embedded taxes. That's Uncle Sam's money, and that's if taxes don't change. Fred and Wilma have been avoiding taxes on the seed, and they're going to pay it on the harvest, and that's exactly what his partner had in mind. And the partner going forward over the next 30 years is the only one with sole power to change the rules. His partner can do anything he wants, taking money out of the cash register, and Fred and Wilma have no say. They can write their congressman, they can write their senator. Good luck. So let's rethink this. Maybe we need a new strategy. Well, I've been a business owner for many, many years, and I built 5 businesses. And I can tell you, if somebody came up to me and said, you know, Jim, I'd like to go into business with you, and let's form a partnership. And in this partnership, I'm going to have the sole power to change how much money I make and how much money I take out of the business, and you don't have a vote, you get what's left. I probably wouldn't want to do that. And if I had a partner like that, I'd probably form a strategy real quick to deal with them. And the strategy I would form would be a buyout. Let's take a look at the Smart Investment Order List. Very good book called Tax-Free Retirement that's out on the market. And in it, the author put out what he called the Smart Investment Order List. I liked it, so I thought I'd put it in my slide here. Number 1, free money. Free money includes inherited money and any money your employer puts in as an employer match on the 401k. Inherited money is good, free. Employer match money is free. That's totally free money. Didn't have to do a thing. Second best money is tax-free money. I think we can all agree with that. Third best is tax-deferred money, only because it's better than taxable money. But that's the Smart Investment Order List. Now, we'll skip free money because that's not an investment. So let's talk about the rest of this, and let's look at each one of these in some detail. You see, any money that you put into your 401k that is beyond the employer match skips the tax-free bucket. It goes directly to the tax-deferred bucket. This is not good. Now, by the way, there is a real, even up to the match, whether or not you should even have a 401k, quite honestly, is a subject for some debate these days. If you'd like to learn more about that debate, I don't have time to do it in this. That's another session entirely. But you might want to look at my blog. It's Jim's Money Blog, J-I-M-S, moneyblog.com. And on the right side, there's a calendar thing down there. Go to the May 13th, 2015, May 13th post. And you're going to see a couple of videos in there, plus what I've put in there. But there's a video in there, the second one, I believe, is they're actually videos from 60 Minutes and from the TV show Frontline about 401k plans and the debate about whether or not they're even right to be a retirement vehicle for people. I'm not going to get into that debate here. We'll just say for the moment that any money that is beyond your employer match probably should not be in this account, because if it is, all you're doing is skipping bucket number 2. It's going to bucket number 3. So we need to do something to get assets in the proper arrangement. Here's a basic understanding of asset shifting. And again, it doesn't happen overnight. It's something you do over time. Obviously, you need an emergency fund. Fred and Wilma, as we noticed, had about $100,000 they wanted to keep as an emergency fund, and that's in their taxable bucket. But anything over that, they should put into the tax-free bucket. 401ks, okay, if you decide you want to have one, only up to the employer match. There's other alternatives available. You can see those on the Money Blog. But only up to the employer match on the 401k if you decide to have one. All excess should be distributed to the tax-free bucket. No unmatched money should be in the 401k. Then third, IRAs. Maintain only the level that will keep, remember, you're going to retire. So let's say 10 or 15 years from now. You need to figure out what your RMD 10 or 15 years from now is going to be with a table. Figure it backwards. You want to make sure that that RMD combined with your Social Security check is below the personal exemptions and standard deduction in retirement. You need to do some reverse engineering. You want to keep the balance of your IRA below the level that will cause that RMD, when combined with Social Security, to trigger taxation on Social Security. So that doesn't mean you don't want to grow the money. It just means you don't want to grow it in this bucket. All excess money goes to the tax-free bucket. So, for example, if Fred and Wilma, we know their personal exemption standard deductions are good, if they're projected, let's say, to be around $40,000 when they're 71, we do the reverse engineering after counting half of Social Security. Want to see what IRA level would be the ceiling amount to keep his provisional income below that 40,000 figure combined with Social Security, and everything else goes into the tax-free bucket. So here we are. Do we do it all in 1 year? No. Like I said, we do it over time, because there are penalties. Number one, if you convert money out of that tax-deferred bucket before age 59 and a half, you got tax penalties in addition to the tax bill. This is not good. And besides, most people don't have $200,000 just hanging around in their closet to pay taxes. So how do we buy out our partner? We use IRS Rule 72T, which allows us to take substantially equal periodic payments on an annual basis, and we can do it for 5 years or until age 59 and a half, whichever is longer. And we avoid the 10% pre-59 and a half penalty. Now, since Fred and Wilma are at age 50, they have 9.5 years. The amount they can take out, of course, is limited based on a variety of factors, including, the age of the account holder, beneficiary, interest rates, yada, yada, stuff like that. But for the purposes of this illustration, we'll say the limit is $20,572 for this 50-year-old married client. You should consult, obviously, with your advisor on what the current limits are. Why would he want to do it now? Well, tax rates are low. Historically, we've already showed you that chart. In fact, Ed Slott, who you're familiar with, our CPA friend here, our retirement guru, says that we're in the lowest tax rates in history. Well, you don't have to be an Einstein to have seen that in the chart. Now is the time to strike to create a tax-free income for your retirement years and beyond. That's his opinion. It also is mine. It's also David Walker, Comptroller General of the U.S., former Comptroller General, and that of others. Number two is deductions. Right now you can itemize. In the future, you may just be left with standard deductions and exemptions. Number three is cash flow, and you'll see why in a minute. Which is worse, paying taxes now at low rates or paying taxes later when you have fewer deductions and you have fewer control over where tax rates go and maybe can least afford them? So, tax-free bucket number one is going to be the Roth IRA. This is the first place you want to go. And it's very simple. There's no taxations on distributions after 5 years or age 59 and a half, whichever is longer. Fred and Wilma can go 9.5 years. And if the money they put into that Roth after age 59 and a half, there's no tax on those distributions coming out of there. There's no Social Security tax. What do I mean by that? I mean that the distributions that come out of your Roth later on that you use for retirement, they're not counted on that provisional income. Remember I showed you that? Those distributions are not counted in provisional income that cause the Social Security benefits to be taxed. That's pretty neat. So, to keep things simple, oh, by the way, the limit on a Roth, funding a Roth, is $5,500 under age 50. Over age 50, it's $6,500 each. That means a married couple can donate $13,000 a year into their Roth IRAs. They can sock away $13,000 a year because they can open an IRA in each one of their names. Now you're thinking, 401k versus a Roth. What's the difference? Is there a difference tax-wise? Well, if there's no change, there's no difference. It's that simple. But if the tax rates go up, even by 1%, you can see it starts making a difference in the value very quickly. I just made up an example here of Gary and Doug with no change, Gary and Doug with a 1% increase in tax rates. At only 1%, you can see there's a change. But tax rates never go up at 1%. How about 5? How about 10? How about 15? The reality is, if you believe tax rates are going up, the Roth makes sense. Now, we're recapturing money. Remember? Fred and Wilma, we said we're going to do 72T. That's that substantially equal payments coming out of his IRA at $20,500 a year. That's going to come out of his IRA. We're going to convert that money into the tax-free bucket annually. Also, those 401k contributions, if they're not being matched, and maybe even if they are, again, go read my blog and make up your own mind about that. That's the May 13th, jimsmoneyblog.com. If the 401k contributions are not being matched, then that's money we don't any longer want to contribute. So we've got the money coming out of the 401 out of the IRAs, $20,500. We freed up money. I've rounded this off, by the way, just to make it easy. $24,000 that we're no longer contributing. That means we're recapturing $44,500 a year over the next X amount of years in order to execute this strategy. By the way, we're not going to deplete the IRA. We're only going to bridle the growth so it doesn't trigger those income that would make Social Security taxable. We're just going to grow it somewhere else. That's all. So at $44,500 a year, that means the total tax bill at a combined 30 rate would be $13,350. Here's what it looks like. We're going to recapture $44,500 a year, and we're going to buy out our partner on the installment plan. Our partner is going to get an annual check for $13,350 to buy out his interest. So he can't decide what our retirement's going to look like as they play their games in Washington. The annual funding of the tax-free bucket then is going to be $31,150. The annual contribution to the Roth, as I said, they can open up an IRA for both of them. And when they open up the IRA for both of them, that's $13,000, and that's going to leave $18,150. By the way, I should explain there are income limits to the Roth IRA. Bill Gates cannot contribute to a Roth. You see, once a married couple approaches 178,000, 112 for singles, the ability to fund a Roth begins to phase out. So that means your children can't contribute either. They have to have earned income. And people who are retired on Social Security can't contribute. They have to have earned income. Because the Roth IRA was designed for Main Street Americans. But if you're having earned income, you can open Roths and contribute to it, and that's where the first money should go. But if you can't, or if you can, the next money goes to bucket number 2. If 18,150 if you can contribute to a Roth, 3150 if you cannot contribute to a Roth. Let's assume you can. So 18,150 goes to bucket number 2. What is bucket number 2? Have you ever said or ever heard anybody say that rich people don't pay income tax? They can't contribute to Roth. I don't think very many wealthy people can. What are they doing? They do know something most people don't. They understand bucket number 2, probably the least understood opportunity in America, because frankly, most people get their financial education from television gurus and magazines written by a lot of 26-year-olds who majored in journalism, and very few, whoever studied economics of life insurance in college or even graduate school. But an LIRP is not your father's life insurance. The kind most of us have heard about, frankly, all of our lives. LIRPs are designed to be financial tools, and they're utilized by 85% of the CEOs of the Fortune 500 companies, as well as quite a few members of Congress. So this is a strategy that Ed Slott, CPA and IRA expert, and David Walker, former Comptroller General, also have talked about. The few people really know much about life insurance. Schools don't teach it. TV personalities are selling their own CDs and DVDs. They don't know much about it. But the funny thing is that Ed Slott sells CDs and DVDs. He's a CPA. He knows about it. And I think he knows what he's talking about. Here's why people use LIRPs. No contribution limits. Penalty fee cash access before 59.5 for any reason. No 1099 tax bill, not included in provisional income for Social Security taxation, in other words. Distributions are tax-free regardless of age. There's no income limits, minimal, if any, legislative risk. We're going to get into that. Multiple accumulation strategies, and boy, the way it does double duty, life insurance as long-term care. A lot of people are paying money into long-term care policies, and if they don't need it, that money's down the drain. That is also reclaimed money that could be recaptured and put in towards retirement and used effectively. So it's all about creating an immediate state. At the same time, you create something you can use during your lifetime. And there's no other vehicle that I know of in the world that does all of this. And if you know of one, let me know. Now remember, Fred and Wilma want to contribute $18,150 each year into their life insurance retirement plan, in addition to the $13,000 that's going into their Roth. So how do we do it? Well, we're going to do it with an investment grade company. If you do that, you have an investment grade financial tool, and one that a lot of people don't even know exists. Remember the ideal balance? You have your emergency fund. You only put money in tax deferred and have it in there up to the point where it doesn't trigger taxation on Social Security when your RMDs are combined at age 70 and a half. All other money goes into the tax-free bucket. Roth up to the max if you're able, LIRP for the rest. And for some people, that would be their plan. Now, the type of policy that you use could be any kind of permanent policy that has accelerated cash value accumulation. My universal life is probably one of the more accepted ones. A whole life can be used if you want to make sure that you have paid up additions and you have a significant amount of time to accumulate. Also, index universal life. I particularly like index universal life, and for reasons that I'm going to enumerate for you in a few minutes. But the index universal life is my personal favorite for this. The real issue is that you can participate in the market indexes, usually up to a cap. There's no downside risk. You never lose money. There is a minimum you have to put in to the life insurance in order to keep the tax benefits, however, because that's what gives you those tax benefits. And it's usually what the insurance company requires. But there's a maximum the IRS allows you to put in because, as I said a lot earlier, remember I said if they limit something, it's good, and if they require it, it's bad. Well, they limit what you can put into a policy because they want your money. That's about what it amounts to. So when they limit something that you can put into something, that's usually a pretty good deal. So that's the important thing to understand. So how much life insurance do you need? What do you need to fund a retirement? Those are really the two real questions. Proper design gives you, and this is why I like Index Universal Life. You have a quicker accumulation of cash value. It's predictable. Almost zero chance of any unpleasant surprises, and you'll see why in a minute. Simple, easy to understand. It can be designed with very few or almost no moving parts. The only part would be the index. It goes up and down determining your crediting, but it can be designed with very few moving parts. The cost of insurance here is similar to term. That's what a lot of people don't realize. It's really kind of an accumulation account on top of a term chassis, except there's no limit in term. There's no term as to the time. Like term is settled in 5, 10, 15, 20 years. This has no limit that way, so it's not a term policy. It doesn't end it on a certain date. But it is, the cost of insurance is very similar to term, which means more money is working for you. So, and there's transparency. No hidden charges, no hidden performance. In fact, one company out there has true performance reporting right on the statement that you can see, and that's pretty neat. That's something I really like. And it performs double duty as life insurance and as a tax-free retirement supplement. Here's the key thing. Most people, when they buy life insurance, they want to buy the most insurance they can buy for the least amount of money. This is the opposite. You want the least amount of insurance for the most amount of money. Why? Because everything beyond the cost of the low-cost insurance goes into your accumulation account, working for your retirement. So it has to be designed properly. And it has to be designed within the limits of the regulations, of course. So why maximum UL funding? Cost of insurance is low. After normal fees and insurance costs, the rest goes into your accumulation account. Funding levels really are limited by the various carriers, whoever the insurance company is. But you get faster cash accumulation available for any purpose, and that can vary among carriers. It costs the government money. That's my personal favorite reason why to do it. They could change the rules in the future, but grandfathering is likely, and I will show you why that later. Triple threat, retirement supplement, life insurance, and you can actually have money available for long-term care and everything else, and I think that's kind of neat as well. And if you don't use the long-term care, the money hasn't gone down the drain. By the way, this feature, the fact that you can have money available tax-free for it's taken in the form of loans in the policy, but in most companies, in many companies, I should say, the cost of the loan equals the crediting of the interest rate, so it becomes a wash. So, but at any rate, why this is attractive to business owners especially is because, think of this, you're a business owner, you've been in business 10, 12 years, you want to expand. Think of this, right now you're going to the bank and you're filling out term sheets and you're turning in applications and you got loan committees and all that stuff. With this, no credit applications, no application fees, no loan committees, no term sheets, no negotiations, no service charges. How do you like it so far? Here's why the wealthy use life insurance retirement plans. Like I said, 85% of the CEOs of the Fortune 500 are doing this. They can draw retirement income tax-free. That means in the second and third decade of retirement, while Uncle Sam is messing around with the tax laws and everybody's complaining during your golf outing, it won't affect you. Your income is tax-free, and whatever Washington does will not affect you, provided you've done everything correctly. Market-like returns with no market risk. You never lose money. Option to continue savings contributions even if you're disabled. Your 401k does not do that. Large income tax-free lump sum to the family if of a premature death. Your 401k doesn't do that. And little or no legislative risk. That is definitely beyond the 401k. Now, no other vehicle, tool, or investment offers all these advantages. I can't think of one. Will the tax laws change? Yes. 1982, 1984, and 88, existing arrangements were continued to be taxed under the old laws. I don't know, maybe it's because Congress has a lot of people in there doing this. In 2005, President Bush had a panel convened to iron out the loopholes, and they recommended changes. But even under those recommended changes, they wanted to grandfather existing policies. Well, the panel recommendations never got implemented anyway, but even they wanted to grandfather. Why do I think this is true? The reason I think that existing policies will always be left alone is because of a very basic tenet in law. You see, you and the insurance company are private parties entering into a private agreement, a private lawful contract. And the government, policymakers and Congress traditionally has been loath to change existing agreements that were entered into lawfully by private parties. They don't go in there and change lawful contracts that they had nothing to do with. And that is the reason that even the panel said we grandfather, because there is a tenet in law there, a doctrine, I guess you'd call it, that seems to be what rules. Now, does this make sense for you? I don't know, but there's probably never going to be a better time to do this. If you're anywhere in your 40s or 50s up to age 60, and even if you're age 60, you may want to give this a look-see. But no two people are alike. Everybody's different. Their goal's different, and whether it would benefit you or not is that's something that only you, an advisor who understands this concept, can sit down and talk about. How much would you save over a lifetime? What would your future look like? How much additional security would you have? I don't know. These are all things that you need to find out. However, if you'd like to schedule an introductory phone call with me, you can go to the infin.com. That's our website, and there's a Getting Started tab. And you can go to that, and you can schedule, there's a scheduler there. You can schedule a phone call with me. And during that phone call, you can find out a little bit about what I do and all of that kind of stuff, and I can learn a little bit about you, and we'll see whether or not it's worth our meeting. My office is in Simi Valley, California, and this is my email here. If you have any questions, feel free to email me. And we'll see what we can work out for you. And if you want to read that or see that blog, don't forget to go to my website. You go to jimsmoneyblog.com. That's down here in the lower right. And it is the May 13th post. I think you may find that interesting. Thank you very much. I hope I can be of some help to you, and I hope you found this worthwhile. Thank you.